Good afternoon and welcome to this week's edition of Halftime Talk. And we're delighted to be joined by Dave Ernsberger, Head of Market Reporting and Trading Solutions at S&P Global Commodity Insights. Welcome, Dave.
Thank you, Sean. It's great to be here and lovely to see you as well.
It's the first opportunity for us to catch up after APEC, which of course was one of S&P Global Commodity Insights' big signature annual events in Singapore, sort of the first kickoff after the summer for the midstream trading industry to get together. Biggest gathering in the annually, really, nearly between IE Week and APEC. But I'm wondering, what was the big takeaways? Of course, Brent crude oil has made a big recovery over the summer months when we were all at the beach. What was the sort of top thoughts that you took away from the APEC gathering?
Thanks, Sean. It's what's nice about APEC is it is a coming together of the trading community, especially ahead of the end of the year, getting ready for the year ahead. And the conversation naturally focuses on a little bit of a look back as to what's happened over the preceding months, maybe for the year, but then very much focus on what it means for going forward in the near term into the early part of next year. And clearly, the number one focus on people's minds was how the oil and to some degree the gas markets have rebalanced themselves over the course of 2023. Specifically, what does it mean that producers are voluntarily holding production back from the market? And that would be the number one talking point for APEC in 2023, I think, which is how did we get to a position so quickly where there's so much supply in the market that, in fact, producers need to withhold production again? Because, looking back to a year ago, oil markets were in turmoil because of the war in Ukraine. The gas markets were beyond turmoil because of disruptions to gas supplies into Europe. And yet here we are just a year later, and the markets are more or less fully rebalanced. There's a lot to unpack in that. But the number one theme was, how long will Saudi Arabia voluntarily keep production off the market? How long will OPEC Plus, and particularly Saudi Arabia's partners?
Was it generally perceived by the APEC? Was it generally perceived, this intervention, as a positive? I mean, the trading world likes volatility. It doesn't really mind if prices are high or if they're not so high. Was this sort of tight sort of micromanagement, as the Saudi Arabian energy minister calls it, sort of like a central bank of the oil markets, where they sort of tightly tweak and keep it under wraps? Is that welcome by the community of oil traders gathered at OPEC, or gathered anywhere at any time of the year?
The trading community tends not to get fixated on rights and wrongs. I think the trading community is interested in economics and arbitrage. And so the lens through which the trading community is thinking about Saudi Arabia and OPEC Plus is really, how long will this go on for? And what's the right trading strategy to have around that? And what's the right way to think about it? I mean, currently, with these voluntary production cuts in place, the oil market is burning off around 2.5 million barrels a day of inventory, of stockpiles. And that erosion of stockpile is what's really driving market structure from contango to backwardation, the rise in the flat price, and more. But the trading community wants to know what's coming at the turn of the year. So that's number one topic, I would say. I would say it's worth mentioning, Sean, as well, that the work has begun around sustainability, for sure. I noticed this year at APEC, and I think people will notice going into IE Week in London next year, that there are real practical things being done, small steps given the scale of the challenge, but important and real steps to start to work towards decarbonization of the supply chains. I mean, we ourselves announced a data deal with Palantir, where we'll be producing carbon intensity figures for supply chains through their platform. And that's really just one example of the kinds of agreements that were being announced at APEC. And we'll see more of those into 2024, I'm sure, from us and from other people as well. So there was also discussion around, what do we do around sustainability? Because it's a real and urgent need that needs to be addressed. And it's practical as opposed to philosophical, which is good to see.
If you take, I mean, one of the comments I saw you post on LinkedIn was in the days after OPEC, achieving affordable, secure, and sustainable energy, that's sort of known as the trilemma, is one of the very biggest challenges our generation grapples with. That is inevitably the big sort of $64,000 question, if when $64,000 was worth something. But I'm wondering, with that thought and coming out of APEC, how big is the gap between industry and governments or states or major NGO actors in that trilemma journey? How big is the gap between them? And which of those three pillars that make up the trilemma do you think industry is dominated by?
Well, the gap is narrowing, Sean, from where it was coming out of the pandemic. I remember COP in Glasgow. People came back from that. That was just as we were coming out of the pandemic a couple years ago now. Government and policy on the one hand, industry, companies, private investment on the other, could not have been further apart on the question of sustainability and energy transition. But there's been a coming together of that. I think on the policy side, there's a recognition that fossil fuels and core energy will supply, significant amounts of our global energy for at least 40 to 50 more years. So that needs to be managed, decarbonized, and dealt with, not simply ignored or denied, right? I think the price shocks of 2022 kind of brought people on the policy side back to a bit of reality around that. On the industry side, there's a recognition that without investment in decarbonization, without investment in new fuel supplies, actually those companies are missing out on the opportunity to take part in the new energy industries that are emerging right now. So we see policy and investment coming together, and this year's COP in the UAE is going to be a pretty important watershed moment for proving that. And a lot of work has gone in by the UAE to bring industry together with policymakers to have a real discussion around this. So we'll see. We'll see how this comes out in the washing in COP this year. But it's closer than it was 2 years ago, and it has some way to go, but it's going the right direction.
I mean, in the days after COP, we had the big statement last week by the IEA declaring that peak fossil fuel demand would be hit before 2030, oil, gas, and coal. That has sort of brought out into the public the sort of face off, if you like, the difference between them and OPEC plus. What impact do you think that kind of gap? Obviously, OPEC plus came out, and OPEC itself made a statement, sort of rejecting that thesis from IEA. That does seem to be quite a big gap between those two multilateral agencies.
Yeah, the IEA and particularly Fatih Birol's statements are a little different to even our own projections for when we see demand for hydrocarbons peaking, demand for core energy types peaking. It's a marker of sorts for the IEA and for Fatih Birol to say before the end of the decade. It's really more of a marker, I think, than anything else. I don't know that demand is actually trending that way right now. And that's probably important. And I think when you read the IEA's comments, they're more nuanced than the headlines suggest. It's a little bit like work needs to be done to get there. If the work is done, here's where we'll be. So I see it as more of a positional statement, a marker in the sand in some ways. I think OPEC's counterpoint, which was unusual, I haven't seen OPEC put out a press release criticizing an IEA position statement, at least not recently. And it was a bit of an unusual to see that come out. But I think the counterpoint from OPEC would be, yes, work needs to be done to get to that point, but absent that work, absent transformation, the world still needs these supplies, and it needs to be done in a secure and an affordable way. So I think actually the debate between IEA and OPEC in the public domain is healthy. I think it also points to this challenge for our generation of secure supply, affordable supply, and sustainable supply. Those three things are constantly at odds with each other. We see IEA taking up a position around sustainability, OPEC around security and affordability, and regrettably, they're both right. We just need to work on all three of those things at the same time. But yeah, that debate publicly was fascinating.
I mean, the other thing that came out last week, between the difference between them, talking about sort of the outlook for oil markets, was the forecast for the shortfall in supply in the fourth quarter, OPEC's declaring a very significant number of 3 million barrels a day shortfall, where demand will exceed supply in the fourth quarter. The IEA, half of that, and even the EIA, the US Energy Department, at a very low level of only 230,000. Your thoughts on that sort of divergence of outlook and the consequence of such a divergence?
Well, we'll see that play out in the market for sure. I've been looking at the IEA and OPEC demand numbers for longer than I can admit on video, and they've always measured demand differently. They've always measured balances differently, and a variance of 1 million barrels a day is on the high side of the variance, but I've seen it before. And a little bit of it comes down to, what do you count as oil? Are you counting LPG and condensates in these numbers? Some of the technical questions around supply, what you're measuring on the supply side and what you're measuring on the demand side, comes to bear there. But all of these agencies agree that there's a deficit in Q4. We agree there's a deficit in Q4. We ourselves are closer to the 2 million barrel a day deficit estimate. And I think largely the difference there is around tomato. I mean, everybody sees a deficit. It just depends on what you're throwing into the supply side of the equation, I suppose.
Well, if you take your earlier comment about the sort of the APEC gathering of the traders and lots of chat about these issues and the outlook for these issues, one of the things that they want some sort of level of predictability, and what OPEC says and OPEC does, and to a great extent, the Saudi energy minister led OPEC Plus of the last few years has kind of, walk the walk and talk the talk, if you like. They've been quite consistently doing what they said they would do. On this occasion, however, my question is, OPEC came out last week, the research entity that sits in Vienna, and put out their forecast of 3 million barrels a day shortfall. And yet the Saudi energy minister came out yesterday, speaking earlier this week, saying that there's no change to the supply policy, even though the OPEC has come out with this 3 million barrel a day shortfall. That in some way is a divergence of walking the walk and talking the talk. I mean, how do you sort of ignore your own research house and maintain predictability? Your thoughts on that?
Well, I think that the measurements of supply and demand and the observations on the market that come from OPEC and the OPEC Secretariat are an input into every sovereign nation's decision making. It's an input into Saudi Arabia's decision making. Same for the UAE, same for Kuwait, same for everybody else in OPEC. But I think it's only an input. I think the countries will always fall back on their own ministry assessment, their own principle. I mean, look, every country has, especially Saudi Arabia, has its own unique perspective on what's actually going on in the market, because they have commercial relationships with their buyers. So I think what we see there is that Saudi Arabia's direct experience of the market is telling it something a little bit different to maybe what even the OPEC Secretariat is saying. They're looking through the market from different perspectives, is really what I say about that.
Dave, I wanted to take the opportunity to catch up with you regarding the changes in dated Brent now that we're 3 months into the new framework of dated Brent, adding and including WTI for the first time from June. The planning switchover triggered a lot of debate in the market as you prepared the market for the change over a few years, maybe even causing some sleepless nights for some physical oil traders. I'm wondering, was that that concern warranted? How has the amended contract performed in the first 3 months? Has there been any big dramas, or kind of business as usual?
Thank you, Sean. And the changes to Brent, the global oil benchmark for crude oil, has been a 3-year project that on the Platts side we've been leading the discussion on. And as you say, Midland came into the Brent benchmark from June of this year. We actually began assessing Brent with Midland included on May the 1st. So we've now got 4 months of observable data around how Midland's performing. And there's a couple of things I'd share on today's team talk, which is, firstly, it's been well embraced by the market. You know, the inclusion of Midland into the Brent benchmark, I think, is now almost universally accepted as a reflection of the fact that Midland is a critical baseload crude oil in the North Sea light sweet crude oil market. It's also, by the way, a critical baseload crude oil in the Asia Pacific light sweet crude market. So there's an acceptance and a support for the idea that Midland is part of North Sea crude economics. So if the philosophical discussion is done because Midland is now in the benchmark, just like it was in Europe anyways to begin with. On the technical side of things, when we began assessing Brent with Midland included in May, you know, Midland was the most competitive grade in the North Sea for about 40% of the time. It effectively was the critical force in shaping the Brent assessment, you know, 40% of the time. In June, it became as much as 75% of the time, which is when you saw a lot of conversation, particularly around, is there too much Midland in Brent? Is Brent simply Midland? These are sorts of conversations we were hearing with the market. It's to be expected that when a new crude comes into a benchmark, market participants and traders want to test the dynamic and see how it works. The dynamic and the methodology performed very well. We haven't heard any complaints or disagreement about how the mechanism worked. And then in July and August, actually, Midland normalized its role in the Brent benchmark. It was around 40% of the time, again, competitive in July, and about 20% of the time competitive in August. So we've seen Midland taking on the balancing element that Forties has, and that even Oseberg and Ekofisk have sometimes. And indeed, Brent itself is the most competitive grade occasionally, even today, even though it's a relatively small stream, right? So that's a bit of a long-winded way of saying it came in, it had a big impact at the beginning, it's now normalized its role, and the market's gotten on with trading. I think the values that we see in Brent reflect the global market, and that's the biggest test of all. I mean, right now as we speak, Brent is closer to $96 a barrel because it's reflecting a tighter fundamental market dynamic than we saw 3 or 4 months ago. And Midland being in the basket has allowed that to happen without disruption, without spikes, without anomalous market behavior. And that's the key reason why it's in the benchmark to begin with.
When you think about, obviously, the benchmark is a basket now with Midland, but previously 5 other crudes, and no 2 crudes ultimately are identical, which makes the magic of this business, I suppose. But do you think Platts eventually have to evaluate precisely how WTI Midland compares with the other grades within BFOET?
So we examine in minute detail the relative competitiveness of Midland, OZ, Echo, Troll, all 6 grades in the benchmark. We examine their competitiveness and their inherent worth every single day. So if anybody wants to know what's the relative value on a refining margin basis, what's the relative value on a spot market basis, we will have that conversation endlessly. Usually people want to pack up and make a run for it once we really get into that topic. So we've been doing that homework from the very beginning of this project 3 years ago, and we still do it today, because the very specific, and we get to the pennies on the barrel, the very specific value of each of these crudes, that is our business, actually. So we're doing it now. We will always be doing it, because the key question for the market is, what is the specific value of each of these 6 grades of crude oil as part of the basket? So that work goes on today, Sean. The other thing I'd mention is, not all U.S. crude is deliverable into Brent. Not even all WTI is deliverable into Brent. It's really a subsection of U.S. crude exports that's deliverable into Brent. And that stream of crude, Midland grade, unblended from the terminals that we've approved, that has a market value which is very different to the WTI and even the Midland you see talked about inside the United States. And that's important too.
Just to wrap up, Dave, one of the other sort of areas of concern before the launch of Midland into the basket was the cargo sizes allowed to be included at 700,000 barrels, which didn't really match the reality of current trading. As you said, a lot of oil moving between the US and Europe now for a while, and they're typically 2 million barrel, very large crude carrier cargoes that cross the Atlantic, but they don't qualify to be included in setting the dated Brent. Has this transpired to be any kind of issue in the first few months?
No issue from an implementation perspective. For Midland to play its role in the North Sea, it needs to trade like crude oil in the North Sea. Actually, North Sea crude and Midland had to meet each other halfway a little bit here. Prior to the change, the cargo size in the North Sea was actually 600,000 barrels. 700 was the more typical Aframax size coming out of the US Gulf Coast. So in fact, we amended from a methodology perspective, the size of North Sea cargoes to be 700,000 barrel Aframaxes as well. So we've done a little bit of reshaping from a methodology perspective on cargoes in the North Sea to accommodate a typical Aframax flow from the Gulf Coast. But that is how a lot of crude flows out of the Gulf Coast into the North Sea, is on Aframaxes. So to fit into the basket, it needs to trade like the rest of the basket, and the market has embraced that.
Well, just to sign off on the inevitable always question, where is the price of oil going to be over the next 3 months as we come knocking on the door of $100 a barrel? Was there any consensus coming out of OPEC, which I think was in the few days in which Saudi Arabia announced that it would be extending its cut through the end of the year? Did that trigger a more bullish outlook for oil prices through to the end of the year?
Interestingly, no. 55% of our audience voted that they expected Platts Dubai to be around 80 to 90 dollars a barrel by the end of this year. You could add a few dollars to that for Brent, although these days they're actually quite close in value because of the sweet sour, light sweet, light heavy spreads out there. But 80 to 90 was the headline number that most people expected to see at the end of the year. We're already above that, but it's not an unreasonable perspective to think that by the time we get to the end of December, the market may have come back a little bit. There's talk already of Saudi Arabia potentially tapering its cuts. We know Russia is quite keen to get more barrels back into the market again whenever the opportunity is there. So it's not unreasonable to think supply might ease up. And of course, these futures markets are always trading 2 months ahead. So as we sit here in September, we're really pricing November. By the time we get to December, we're pricing February and March. And that is a relatively slack period for demand. So 55% of the audience said below 90, but above 80 by the end of the year. It doesn't seem unreasonable sitting here in September.
Well, it certainly would be the appropriate number for what is of critical importance to the producers where I'm sitting here in the Gulf, and that is what is the average price of Brent through the course of 2023. And I think indeed that will be in that $80 to $90 bracket, unless we see some meteoric rise into the hundreds. And I think that it would be a sweet spot that everybody would be happy with. Listen, we'll have to wrap it up there. Absolute pleasure to catch up with Dave Ernsberger, Head of Market Reporting and Trading Solutions at S&P Global Commodity Insights. And we didn't even talk about Southampton. We'll have to leave that for another day.
We'll save that for another time. See you in October. We'll talk about it there.
Okay. Thanks, Dave.
Bye.